Hey everyone, it's Julie here with TipRanks, and today we're taking a look at 3 strong buy dividend stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 dividend stocks that all come in with a strong buy consensus from Wall Street analysts. The inspiration for these stocks today was the TipRanks Smart Dividend Investor newsletter. This newsletter comes as a weekly email with an inside scoop on high-quality dividend stocks, following a carefully curated model dividend portfolio and providing comprehensive dividend portfolio insights. The dividend newsletter also highlights a carefully selected high-quality dividend stock recommendation every single week. So today we're going to take a closer look at that dividend stock of the week, plus 2 other stocks in that model portfolio that come in with a strong buy rating. If you're interested in learning more about this dividend newsletter, links will be in the description down below. And of course, if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. Let's get right into our 3 strong buy dividend stocks. First on the list, we're taking a look at Cigna. They trade under the ticker CI, currently priced at $351.53. In the past year, the stock has climbed 14.6%, and in the last 3 months is up 6.5%. Cigna is a global insurance and health services company. They were founded over 230 years ago, back in 1792, as the Insurance Company of North America, or INA, and over the years have made a lot of changes. In 1982, they became known as Cigna and started focusing more on healthcare. They now offer these health plans and services to individuals, families, businesses, and organizations with medical, dental, life and accident, disability, and supplemental insurance products. They use data and analytics to understand the specific disparities a population may face based on their geographic location. Cigna has been paying an annual dividend since 1983, but only just recently introduced a structured quarterly dividend plan back in 2021. And they've been consistently growing this dividend as well. Earlier this year, they increased their quarterly dividend to $1.40, which was a 14% increase, for a dividend yield of 1.55% and a very healthy payout ratio at just 20%. They shared a solid Q2 earnings report back at the start of August, with both an earnings and revenue beat and reaffirming their future guidance. Their third quarter will be coming up in just a couple of weeks on October 31st. Third quarter, analysts are anticipating earnings per share of $7.23, which would be a notable increase over last year's. This follows their Q2 earnings per share of $6.72, which beat by 29 cents. The company had revenue of $60.5 billion, which did beat by over $2.1 billion and increased 25% year over year. The most recent analyst rating on the stock does come from Bernstein. They reiterated their buy rating, noting Cigna's unique presence in both pharmacy benefits and medical benefits administered in provider settings puts them at an advantage to capture a significant portion of the roughly $400 billion market. With a focused growth strategy, Cigna is expected to leverage industry growth and gain additional market share through their strategic initiatives, setting a robust foundation for sustainable long-term earnings growth. The Cigna stock currently has 13 analyst ratings, coming in as a strong buy with 11 buys and 2 holds. And the average price target comes in at $400 per share, implying an upside potential of 13.8%. We can see our most recent ratings here down below, with our high-end price target coming from JP Morgan at $438 for an upside of 24.5%, while our low-end price target is a hold back here in August, a pretty flat price target, a slight upside of 0.9%. Our second strong buy dividend stock is Phillip Morris. They trade under the ticker PM, currently priced at about $120 per share. Their stock has climbed 35% over this past year, and in the last 3 months has gained 15%. Phillip Morris is a leading international tobacco company, and while the excitement around traditional tobacco may be dying out, the popularity of smoke-free alternatives is rising. They are building their future on replacing cigarettes with their smoke-free products that, while they're not risk-free, are a better alternative than cigarette smoking, and they say this is the biggest shift in their history. PMI has 2 smoke-free product research facilities in Switzerland and Singapore, and over 1,500 research and development scientists, engineers, and technicians working on their smoke-free products. As of June 2024, 38% of their total net revenues did come from their smoke-free products. And Phillip Morris has paid and increased their dividend consistently since becoming a company back in 2008, meaning they are getting very close to dividend aristocrat status. They have a compound annual growth rate of 7% for their dividend, and the most recent was $1.35 for a dividend yield of 4.37%. Their Q3 earnings report is coming up next week on October 22nd and does follow an earnings and revenue beat for their second quarter, plus some full-year profit guidance that topped expectations. For their Q3, they're anticipating earnings per share of $1.82, which follows their Q2 earnings report of $1.59. That beat expectations by 2 cents per share. Revenue climbed about 5.6% year over year to $9.47 billion, beating estimates by $280 million. They said that the excellent momentum of their smoke-free business continued with an outstanding second quarter and first half performance. Recently weighing in on the stock was an analyst from Citi. They reiterated a buy rating on the stock, saying they anticipate continued solid volume growth in heated tobacco units and Zyn, a smokeless tobacco product, complemented by a steady showing in traditional combustible products. Their report suggests resilience across Phillip Morris's product portfolio, with particularly strong growth forecasted for the company's next-generation products. With 8 current analyst ratings, Phillip Morris does come in as a unanimous strong buy. And the average price target comes in at $135 for an upside potential of over 13%. Looking at those ratings down below, we do have quite a few analysts increasing price targets on the stock. Our high-end price target does come in at $150 for an upside of 25%, while our low-end price target comes in at $123 for an upside of 2.6%. If you've made it all the way to our third stock today, then this is a reminder to make sure you hit that thumbs up button. Last but not least, we're taking a look at BlackRock. They trade under the ticker BLK, currently priced at $993 per share. The stock has climbed 60% over the past year. This is one that we did talk about back around the end of June, I believe it was. In the last 3 months, the stock has gained over 21%. BlackRock is a global investment manager. Founded back in 1988, they are one of the world's leading providers of investment, advisory, and risk management solutions, with 19,000 employees across 36 different countries. They offer a variety of services, including investment management, managing investments on behalf of clients, including funds like cash funds, stock funds, and multi-asset funds, and different risk management and sustainable investing projects. BlackRock has dividend payments dating back to 2003, and their current quarterly dividend comes in at $5.10 per share for a dividend yield of 2.05%. Over the last 10 years, they have a compound annual growth rate of 10.5%. And they just shared their Q3 earnings report on October 11th, coming out with both an earnings and revenue beat. For their Q3, they reported earnings per share of $11.46, beating expectations by $1.01. Revenue increased nearly 15% year over year, coming in at $5.19 billion, beating by $270 million. Management noted that the assets they manage on behalf of their clients reached a new high, ending the third quarter at $11.5 trillion, having grown $2.4 trillion over the last 12 months. Coming out with a street high price target and a buy rating after that earnings report was an analyst from Morgan Stanley. He sees potential for operating margin expansion, which underpins his projection of an over 15% earnings per share compound annual growth rate from 2024 to 2026 estimates. This is further bolstered by investor re-risking behavior and a strong asset growth pipeline, enhanced by the recent acquisition of GIP, which is expected to contribute to organic base fee growth. BlackRock currently has 17 analyst ratings, coming in as a strong buy with 15 buys and 2 holds. And the average price target comes in at $1,026 for an upside potential of 3.35%. Looking at some of those more recent ratings, though, we do see some higher upside potential. Our low-end price target does come from back at the start of October with a downside of nearly 13%. Looking at some of our more recent ratings, that high-end price target does come from Morgan Stanley with an upside of over 25%. So that is a quick look at 3 strong buy dividend stocks inspired by the TipRanks Smart Dividend Investor newsletter. Let me know your thoughts on these 3 dividend stocks in the comments down below. I always appreciate hearing from you guys. And if you want to learn more about the newsletter, don't forget you can follow those links down below as well. Please keep in mind these videos are never a suggestion to buy or sell any specific stocks, so make sure you always stick to your own investment plan. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.